Hello friends, this is Vijay Bambani here. I hope you're doing really well in the markets, both on the trading and the investing front. Now in this video, I'm trying to address a concern that many of us are feeling of late. And this is something which is not just India specific, but is being experienced the world over. What if inflation rises? And what if inflation is here to stay? Remember, almost all governments have printed unbacked currency, flooded that money into the economy, into the financial markets, and given stimulus and pump primed their economy, which means that inflation is bound to rise. Now, in this rising inflation, your cost of living is likely to go up. The fact that you're investing or trading in the market means that your income, ideally, in a best case scenario, your income must exceed your expenses, both survival and to a certain degree lifestyle expenses, so that you are not distressed. But is there a difference between trading and investing in a high inflation scenario and a low inflation scenario? I think yes. For example, if you're a veteran driver, if you've driven a vehicle, a two-wheeler or a four-wheeler through many years, you will realize that the experience of driving differs on whether the day is a sunny day or it's a rainy day, or if you're driving in a cold climate on a foggy day. You have to adjust the speed of your vehicle depending on what kind of visibility, what kind of road conditions, what kind of weather you are driving through. Ditto for investing and trading. Now, since we are expecting a probability of inflation rising, in this video, I'm going to talk about what you can possibly do to mitigate some of the blow that inflation is likely to bring with it. Now, people like me like to call inflation as misery. And the inflation index is something that we called the misery index. Many economists also like to call inflation as taxation by another name. Now, look at the hypothetical scenario of you going to the market to buy a kilo of potatoes and tomatoes. Every week, if you were to go to the market and pay 1 rupee more than the previous week for a kilo of potatoes, your impact is likely to be the same as the inflation remaining constant, but the government levying more tax on you, because the amount of money that goes out of your hand is the same, right? So many economists, especially the Austrian School of Economics, believe that inflation is taxation by backdoor means. Therefore, you will experience some cash crunch, some discomfort in your kitchen and household living in high inflationary times. Therefore, fixed income securities that have fixed interest and a coupon rate, as we call it, invariably let you down during these high inflation times, unless you basically are investing in inflation adjusted bonds. Do these exist? Yes, they do. But do they insulate you completely? No, they don't. There is an old saying amongst arbitrageurs and hedgers: a perfect 100% hedge is yet to be invented. So nothing can insulate you a full 100%. That protection does not exist. So your fixed income securities, especially bonds and sovereign debt, etc., will give you return on investment, that is for sure. But as far as returns are concerned, they might just be below real effective inflation rates, which means negative yields. Inflation usually means the rise in price of commodities which makes commodities a better bet in times of rising inflation as compared to equities. Do note that during times of galloping inflation, raw material costs, which is commodities, are rising. Therefore, corporate profits tend to fall. So, park your funds in hard assets, which is commodities, during rising inflationary times, and take this money out when hard asset prices stop rising and invest them back into equities. That will protect your money and also ensure that not only do you have a store of value, but you also have capital appreciation as well. I prefer in the hard asset space bullion because it has a track record of 3,000 years, proven track record of 3,000 years as not only a store of value but also a capital appreciative instrument during inflationary times. Now, depending on whether your pockets are deep enough, if you are a high net worth or an ultra high net worth investor, investing in real estate for the long term is also a good idea during the initial stages of rising inflation because of the fact that the supply of land is unlikely to rise. However, the human population continues to grow, and therefore when the fiat currency, which is a paper currency, due to high inflation erodes its purchasing power, what is known as purchasing power parity, real estate prices decade after decade will go higher. Do remember that real estate as an investment class is infinitely less liquid as compared to equities. You want to sell 10 crore worth of rupees 10 crore worth of shares, depending on which kind of company you've invested in. If it's a frontline large cap company, you can get the value of 10 crores in a minute or two. You can simply dump those shares and take a payout in T+2, which is transaction day plus 2 working days. But you can't sell an apartment in 2 days. So I'm talking of real estate in multiples of years and decades rather than as a short-term investment. So high net worth and ultra high net worth individuals should basically consider real estate as a viable option during high inflationary times, especially if inflation is likely to be sticky. The one thing that I cannot emphasize enough is that you have to be continuously on your toes and shuffle your money in and out of asset classes during high inflationary times. Now, this might go against the philosophy of some people who say, even though the market is falling and they're basically talking about following the Oracle of Omaha, etc., I'm not against that. I have no dispute against it. I'm very sure that long-term investments yield you multiplication of your capital. But why stick to an asset which is going down during a down phase? If you were to get out of that, you will pay profit, you will pay taxes, but taxes are paid on your profits, not on your capital. Invested elsewhere, like for example, hard assets, if for 2 years inflation is going to rise, you take your money out of equities which are susceptible to inflation, put it in hard assets which again give you capital appreciation, take it out after 2 years, pay tax on it, and then go back to equities after inflation bottoms out and starts rising again. You will, in spite of the fact that you've paid taxes on your profits, still be better off than your contemporaries who rode the price all the way down and then come up all the way up to ground zero. I would say that being nimble-footed and on your feet during inflation times, the will, the need to move your money in and out of assets is very important. That's what separates the super cool investors and traders from the regular guys. I hope this helps you formulate a good roadmap for you in inflationary times and helps you become better traders and investors. I bid goodbye to you, not before reminding you to subscribe to my YouTube channel if you haven't already done so. click on the bell icon to receive instant alerts about videos being put up out here. In the comment section, keep your feedback coming, good, bad, love, hate. I welcome everything with open arms. Help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. I wish you all the success and all the profits in the markets. I hope you're staying safe, taking care of your investments and trades, your health, your family and friends. Thank you for your patience. Thank you for watching my video. Vijay Bambwani signing off for now. Take care. Bye-bye. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.